In this week's video, we'll review the hard evidence and answer the question, how concerned should we be about recent weakness in the stock market? Here are some of the topics we'll be covering this week. We'll look at the moving averages that we used for 1987, 2008, and in the flash crash video and see how they look now. We'll also compare them directly to 2008. How do bonds versus stocks look now relative to a correction in 2011? And we'll cover these charts and topics as well. To view the video in full screen mode, use this icon in the lower right hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right hand corner of your video player. This is a daily chart of the S&P 500 as of roughly 3:15 p.m. on Friday, July 11th. These are the moving averages here that we've used in past videos, including a Was There Anything You Could Have Done 2008 video. This is what full bore risk off looks like. My fastest moving average in blue is on the bottom. My slowest moving average, the 200-day, is on the top. You'll notice price is below all of the moving averages, and the slopes of all of them are negative, which is indicative of a bearish trend. This is what we should be very concerned looks like. You can see the present day doesn't look anything like that. In fact, it's almost the mirror image. Instead of price being below all the moving averages, it's above all the moving averages. Instead of blue being on the bottom, blue is on the top. Instead of the moving averages having negative slopes or bearish slopes, they have positive or bullish slopes. The net is we have not seen anything too significant. We do see some cracks in the observable evidence, but for the most part, the trend is still clearly bullish from an observable evidence perspective. This chart needs to morph into something more like this for us to become more concerned and have to make allocation changes relative to our rules and the market model. One of the strengths of the market model is it uses ratios or risk off versus risk on charts. In this case, we can learn a lot more about the market's tolerance for risk by looking at a chart like this versus just looking at stocks in isolation or looking at long-term treasuries in isolation. This is the current ratio of treasuries relative to the S&P 500. It's the dotted line here. You can see treasuries did do well this week relative to the S&P 500 as of late on Friday. However, we do not have a bullish moving average crossover. This is what a full bore bullish look looks like in favor of treasuries. And more importantly, this is a correction here in 2011. This is the S&P 500 in black trending sideways here, and then it plunged. You'll notice treasuries were outperforming the S&P 500 for several months before this waterfall decline. TLT crushed the S&P 500 during this period here as the stock market tanked. You can see the present day really doesn't look anything like this. This is quite a bit different than this. We have a consolidation here, and we have several forms of potential resistance overhead for treasuries. We'll keep an open mind about this chart, but even with the performance of treasuries in the past 5 trading days, this chart still says I'd rather be in stocks. This is emerging markets EEM relative to TLT on a weekly chart. You may say I'm not really interested in emerging markets, but we can learn something about the market's tolerance for risk, even relative to U.S. stocks, by looking at this chart. This is EEM relative to TLT, and you can see this was support. What once was support may now act as resistance, We have resistance here, and a bullish breakout. So we have somewhat of a mixed bag here. you can see emerging markets have been gaining ground relative to treasuries. If this ratio can break into this area here and clear this resistance level and this one, and what previously was support, all things being equal, that would be good for the stock market because it speaks to a reflationary outlook that the money printing might be making its way into the economy, and we'd rather own maybe weak dollar related emerging markets rather than treasuries that could be hurt by inflation. Nothing clear here, but this is still leaning in the bull's favor and favors equity over treasuries. Similar concepts here, so we'll move quickly. This is emerging markets relative to the S&P 500. We have somewhat of an indecisive look, but again, emerging markets have been making some progress. For us, we'd like to see step 3 happen. Bullish break of a trend line, step 1. We've made a higher low relative to this low. If this ratio could make a higher high and close above this level here, that would improve the probability of emerging markets outperforming the S&P 500. For now, there's resistance, resistance, resistance. We'd like to see this ratio get into this area here for emerging markets. We mentioned earlier in the video that we have seen some cracks. Here's one of them. This is home construction or home builders. ITB relative to the broader S&P 500 index as of the close on Friday, July 11th. It's actually 45 minutes before the close, but not much changed in that 45-minute period. You can see this is bullish for home builder stocks. Part of that is the market is not expecting a rate increase from the Fed here. Now that a rate increase is becoming something a little bit more real, home builders have struggled a little bit. But from an economic perspective, this is a little bit concerning. This is a lower low here. This has a full-bore bearish look in favor of the S&P 500 over ITB. How concerned should we be about this? It really depends how long the look of the previous chart lasts. ITB generally has a positive correlation to the S&P 500, but there are periods where it actually has a negative correlation. So it's not that concerning in the short run, and you can see ITB in isolation for the most part here is still in an upward sloping trend channel and is consolidating. If it moves into this level here, obviously, and breaks potential support, our concerns would increase. But this really doesn't look too bad right now. We don't even have a bearish moving average crossover on the weekly chart of ITB. Some of these charts that we're using, these relative charts, are part of our ETF scoring system, and they're not part of the core market model that determines allocations. However, they are part of the ETF scoring portion of the model. So some of these are more anecdotal in terms of evidence, but you can see here the stock market bottoms in here, but gold was already anticipating money printing and the expectation that inflation would potentially pick up. All things being equal, if this chart, if gold can start to outperform the S&P 500, that actually might be a good thing for stocks because it leans towards inflation expectations picking up. Right now, gold has been really a loser relative to the S&P 500 since the spring of 2011, and as we sit now, we still have a lower low here relative to this low, and we don't have a bullish moving average crossover yet. Gold has improved in recent weeks, but we prefer this to morph into something that looks more like this or this before we become interested in potentially buying GLD. For now, we'd prefer to be in stocks because the long-term trend still favors stocks. Since we've looked at treasuries, we'll move quickly here. This is the aggregate bond market, or a diversified basket of bonds relative to the stock market. You can see here when the ratio starts to pick up, this is what fear looks like as the demand for bonds is increasing relative to the demand for stocks. This helped foreshadow this waterfall decline in the S&P 500. You'll notice this ratio is rising for several months before the waterfall decline. That's not what we have now. In fact, we had an indecisive box that broke in favor of equities over bonds, and we had a little bit of a bounce back this week, but the trend still says I'd rather be in stocks over bonds. If you're new to the fold, we're going to move quickly here and show regular viewers momentum for the Nasdaq. The Nasdaq was weak during the previous 5 trading sessions, but you can see momentum stays in overbought territory clearly. The probability of good things happening is still favorable when you're in overbought territory. And as we know, when we drop out of overbought territory on a closing basis, the probability of bad things happening increases. This is a weekly chart, so that's a fairly significant decline. Drops out, fairly significant decline. Still looks good. Everything that we just said about the weekly chart of the Nasdaq applies to this chart. Momentum is still strong in an overbought territory despite the pullback this week. We'll try to move quickly here as well. This is the weekly S&P 500 here. We use the moving averages to discern between volatility to ignore, and volatility to respect. A full-bore bullish look is when price is above both blue and red. Blue is above red, and the slopes are up, telling us that the probability of good things happening has increased. Conversely, a full-bore bearish look is when price is below blue and red. Blue is below red, and the slopes of both are down, telling us that the probability of bad things happening has increased. You can see we still have, for the most part, a bullish look. We definitely don't have a full-bore bearish look. A little bit of a mixed look. The slope of this is down. Price is below it. But overall, this looks pretty good. I had a client ask us a question about this consolidation here and breakout, asking, would this potentially act as strong support on a pullback? The answer is yes. If we pull back all the way to 1878 or so, regardless of whether this holds, and we always refer to support as possible support, so we keep an open mind. If we come back here, the probability would be good that this would hold. And if it doesn't hold and we break below this area here, we also learn something from a bearish perspective. From a momentum perspective, this is the current momentum. Look how strong that is. This is what concerning momentum looks like. This is a big yellow flag here. Strong momentum, come up here, almost make a higher high, weak momentum, waterfall plunge. This really doesn't look anything like this. If this morphs into something like this, which it may, our concerns would increase and it will begin to check bearish boxes in the CCM market model. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shravaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.